$108 million in net profit stands as a historic high for a local platform giant. Yet it hides a structural cash reality that most retail investors completely overlook. When institutional analysts chase a 12.20 Singapore dollar price target, they are pricing a high-growth tech engine rather than a reliable wealth sanctuary. For a 55-year-old Singaporean counting on sustainable distributions, this mismatch reveals why a multi-billion-dollar ecosystem can simultaneously be a brilliant business and a hazardous income trap. Tracking the local capital markets means separating the operational noise of corporate expansions from the cold reality of what drops into your Central Depository account. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. The headline looks spectacular, with 108 million Singapore dollars in net profit setting a record. But we have to look past the initial excitement, because institutional analysts chasing that 12.20 Singapore dollar target are pricing a growth engine, not a retirement sanctuary. For a 55-year-old investor counting on distributions to handle daily expenses, this structural mismatch is a hazardous income trap. Which brings us to what we are actually doing here. Our operational baseline is simple. We must separate the noise of corporate expansion from what actually lands inside your CDP account. We read the numbers that the major headlines skip, focusing directly on interest coverage, gearing, and free cash flow sustainability. This brings institutional-grade rigor to heartland portfolios, ensuring you do not get caught up in growth narratives that fail to deliver cash flow. Let us look at how the institutional analysts view this situation. The institutional thesis from RHB remains highly aggressive, reiterating a buy rating on iFAST Corporation Limited with an unchanged price target of 12.20 Singapore dollars, which implies a 36% capital upside from the current price of 9.110 Singapore dollars. But remember, this analysis applies my 4.7% minimum yield hurdle, an income threshold designed for retirement portfolios, not a capital appreciation target. Let us dive into the core mechanics of their growth thesis. HB's forward valuation relies heavily on recent infrastructure enhancements within iFAST Global Bank, specifically the rollouts of the LP Plus worldwide scan and pay cross-border QR payment rail for retail clients and single Euro payments area rail support for corporate multi-currency accounts. The analyst frames these cross-border rails as strategic ecosystem enhancers designed to drive user stickiness, accelerate corporate deposits, and lower costs compared to the legacy SWIFT network, rather than standalone profit centers. Let us see where they expect the long-term compounding to come from. The institutional investment case is anchored on the long-term compounding of the group's asset-light wealth management platform, regional pension administration contracts in Hong Kong, and scaling digital banking assets in the United Kingdom. Management openly acknowledges that the near-term earnings impact from these new payment launches will be highly restricted. This brings us directly to the operational risks the house has highlighted. Every growth story carries its own structural friction, and RHB explicitly identifies three key risks: asset under administration fluctuation volatility, regional regulatory adjustments, and foreign exchange translation exposure. These factors mean that near-term earnings remain tightly restricted as infrastructure scales up. This reveals the core assumption underpinning the entire buy rating. The entire institutional investment case rests on one load-bearing assumption. RHB assumes iFAST can successfully scale its digital banking assets and multi-currency payment infrastructure into high-margin recurring fee streams before rising infrastructure costs compromise platform profitability. If those costs ramp up faster than the fees, the model breaks. Now let us run this growth narrative through our forensic screen. When we step away from institutional growth models and look at absolute debt safety and cash reliability, the picture changes. Because a banking entity subsidiary is present, we apply corporate parameters with contextual reference to client-related liabilities. Our checklist tracks four distinct gates: the yield gate, gearing gate, interest coverage ratio gate, and leverage gate. Let us see how the metrics stack up against our thresholds. Looking at the real-time data, the yield gate fails immediately, with a trailing dividend yield of approximately 1.3% based on a 12.0 dividend per share, missing our 4.7% floor. The gearing gate passes comfortably at 10.6% debt to assets against our 35% ceiling. However, the interest coverage ratio gate fails, landing at 3.34 times on a trailing 12-month basis against our 4.0 times hard floor. The leverage gate passes with a negative net debt to EBITDA of negative 4.55 times. Let us audit the raw facts behind these parameters. With the current price sitting at 9.110 Singapore dollars, we need to audit the exact balance sheet items. Total corporate debt stands at 286 million Singapore dollars. That breaks down as short-term borrowings of 17 million, a current long-term portion of 10.4 million, long-term debt of 218.6 million, and capital leases of 40 million. Cash and short-term investments total 1.27 billion Singapore dollars. And trailing 12-month finance costs stand at 54.45 million Singapore dollars against operating income of 181.75 million. Let us look at what is driving that interest coverage contraction. The contraction in our interest coverage ratio to 3.34 times is not a sign of weakening credit quality or balance sheet distress. It is driven by rising structural interest expenses as the banking wing scales. Specifically, deposit interest owed on licensed banking liabilities at iFAST Global Bank in the United Kingdom, not traditional corporate debt servicing. Gross corporate gearing itself remains exceptionally lean at 10.6% on a debt-to-assets basis and 66.9% on a debt-to-equity basis. To understand this structural shift, let us compare it to a major peer. While SGX Group is not a perfect comparator because no other listed Singapore entity runs an identical hybrid wealth platform and digital bank, the contrast is highly instructive. iFAST matches a 33% operating margin against SGX's 50%. But its interest coverage ratio is a thin 3.34 times compared to SGX's 20 times plus. This proves that taking on licensed banking infrastructure creates a materially heavier interest burden than a pure asset-light exchange model, even when gross corporate gearing stays low at 10.6%. Let us run this through a forward stress scenario. Our stress test shows that a 10% compression in platform operating income or a 10% escalation in bank infrastructure interest costs would compress the current interest coverage ratio down to 3.01 times, driving it deeper below our safety parameters. For a heartland retiree, the wallet reality is stark. A 1.3% yield heavily underperforms the 4.0% risk-free sanctuary of the CPF special account. You are taking open market equity volatility with zero matching income compensation. This leaves us with two soft flags present: the sub-floor interest coverage ratio and the fact that it trades above its asset-backed investing pro fair value baseline of 11.24 Singapore dollars. Let us examine the dividend trajectory to see if relief is coming. The distribution ledger is clear. iFAST is explicitly prioritizing reinvestment over immediate retail shareholder distributions. The trajectory has effectively flattened across the last 3 reporting periods. Let us trace the exact numbers. Looking closely at the ledger, the ordinary dividend per share, set at 10.5 Singapore cents in fiscal year 2024, moved to approximately 12.0 Singapore cents in fiscal year 2025, and remains at approximately 12.0 Singapore cents on a trailing 12-month basis as of the first quarter of 26. Special dividends, capital returns, and sponsor subsidies are completely absent across the board. Despite over 12 consecutive years of distributions, the growth has stalled. Let us look at the underlying payout math. The reason the trailing yield is locked at a sub 2% level comes down to a conservative 25% payout ratio. Total cash distributed in fiscal year 2025 was approximately 22.75 million Singapore dollars out of a net profit of 100 million. Under any asset under administration stress or margin compression scenario within the United Kingdom Digital Bank, the board's strict focus on capital preservation means there is no short-term path to clearing our 4.7% minimum floor. Let us look at the fundamental analytical gap this creates. To understand why an institutional analyst views iFAST as a compelling buy, while our framework flags it with caution, we must look at the total misalignment of investment horizons. The institutional case is built entirely on forward scale, while our screen is anchored strictly on current income safety and structural yield. Let us compare the core features side by side. Long contrast is clear. RHB holds a buy rating driven by ecosystem expansion and asset under administration scale, targeting a 12.20 Singapore dollar price, focused on capital appreciation over a tactical growth horizon, and views currency or fee volatility as managed. Our forensic screen issues a Zone 4 caution driven by a structural yield deficit and subfloor interest coverage, uses an 11.24 Singapore dollar baseline, prioritizes sustainable retirement income, and flags real-time income dilution against risk-free rates. This structural divergence brings us to the core balance sheet paradox. iFAST holds a massive net cash position of 987.75 million Singapore dollars, which is roughly 3.5 times its trailing 12-month EBITDA. This creates a near-zero risk of operational default. However, because that cash must back licensed banking deposits, it completely dominates the 1.87 billion Singapore dollar current liabilities line. The critical takeaway is clear. The strength that protects the business from credit distress is the exact same strength that keeps your dividend distribution small. Let us clarify why this lands as a caution rather than a red zone entry. This stock lands within Zone 4 caution because the low trailing yield is a deliberate, well-capitalized policy choice by the board, not a sign of financial distress or operational cash collapse. Net cash is strong, corporate gearing is exceptionally low, and the conservative 25% payout ratio means the board is actively choosing to retain capital to fund its bank expansion. A company that cannot pay presents an entirely different risk profile than a company that chooses not to pay yet, meaning a visible path to change remains intact. Let us capture the core lesson from this digital bank land grab. The institutional excitement over new cross-border payment rails completely ignores the heavy toll that operating a digital bank takes on interest coverage metrics. Institutional analysts focus on the long-term fees generated when regional retail clients tap into global merchant networks. But our forensic audit reveals that trailing interest expenses have climbed to 54.45 million Singapore dollars, driving the interest coverage ratio down to a thin 3.34 times. When a growth tech platform takes on bank infrastructure costs, the interest servicing requirements expand faster than net fee income. The forensic punchline is simple. Do not mistake a well-capitalized banking land grab for an income-producing asset. Let us map out the key milestones we need to track next. To track whether this policy choice framing continues to hold, we must monitor three distinct structural catalysts over the coming quarters. These milestones will give us a clear indication of whether the balance sheet mechanics are shifting back in favor of retail income investors. Let us look at the immediate dates and metrics on the radar. The first major catalyst is the upcoming second quarter earnings release scheduled for the 23rd of July 2026. We need to monitor the core operating income line closely to verify if fee expansion from the Hong Kong pension business can successfully reverse the downward trend in interest coverage. This release is also the named catalyst behind the stock's watchlist status, as any meaningful shift in forward payout guidance will tell us if the capital preservation policy is adjusting. Let us look at the next load-bearing metric on the balance sheet. Next, we must track the 54.45 million Singapore dollar trailing 12-month interest expense line. A structural drop in banking finance costs below 45 million Singapore dollars is required to move the corporate interest coverage ratio back toward our 4.0 times hard safety threshold. Until this metric recovers, the interest burden from the digital banking infrastructure remains too heavy for defensive income standards. Let us check the final operational policy trigger. Finally, we need to watch for any formal guidance from management signaling an increase in the historical 25% ordinary dividend payout ratio during upcoming quarterly declarations. Without an explicit policy pivot toward returning more capital to shareholders, the yield cannot scale to meet our requirements. Let us run this structural reality against the guaranteed alternatives in the market. For a retired or retiring Singaporean managing personal capital outside the CPF system, buying an asset at a 1.3% trailing yield when the 6-month T-bill sits at 1.47% and the CPF special account guarantees 4.0% is a direct compromise of portfolio discipline. Growth narratives do not pay for daily electricity tariffs that are rising quarter on quarter or public transport hikes. You are exposing your retirement capital to open market equity risk without receiving matching income compensation. The forensic punchline is clear. When an equity yield underperforms a risk-free cash sanctuary, the smartest trade is standing completely still. Let us look back at how these balance sheet markers always signal trouble in advance. In this market, the difference between a sanctuary and a yield trap is decided before the opening bell, not after the damage is done. The red flags are always there. The question is whether you had the forensic framework to read them in time. Let us look at how elite access completely shifts your posture as an investor. Iggy's elite investors did not chase the headline yield. They had the full forensic breakdown, the gearing ratios, the occupancy gaps, the debt overhang, before the market opened and before the price moved. Zero-day reports, the complete red zone watch list, and institutional-grade cheat sheets that flag the landmines disguised as opportunities. For 9 Singapore dollars a month, less than a kopi and kaya toast set at Ruffles Place, you stop being the exit liquidity and start being the analyst. Let us summarize our final position on this asset. iFAST Corporation Limited lands within Zone 4 caution under this fresh forensic screen. The organization's net cash position of 987.75 million Singaporean dollars provides an unassailable operational safety buffer that protects it from genuine credit distress, and that strength is precisely why this verdict sits at caution rather than red zone. The asset cannot clear the strict gates established for sustainable income allocation, but the failure is one of policy, not structural collapse. And let's be honest, chasing growth platforms at history-high market regimes when the benchmark index is hovering above the 5,000 level requires a risk profile that does not align with a defensive wealth strategy. Turning to our core alignment, let us see how the portfolio logic connects with these figures. For an investor relying on steady, capital-preserved drawdowns, a structural yield of approximately 1.3% combined with an interest coverage ratio that misses our 4 times hard ceiling means the business logic and the portfolio logic are fundamentally pointing in opposite directions. This is not an operational critique of management's digital banking rollout in the United Kingdom or its payment rail partnerships with Alipay Plus. It is a forensic confirmation that the capital appreciation objectives of institutional funds do not match the cash distribution necessities of heartland retirement portfolios. The Zone 4 verdict here is not a permanent rejection, it is a forensic timing signal. At the current yield and price, this stock is not compensating you adequately for the risk you would be taking on. But that changes when the yield clears the hurdle, when the balance sheet strengthens, or when the price corrects to a level where the math works. When any of those conditions are met, Iggy will say so. But until then, the framework holds because the framework exists precisely for the moments when there is pressure to compromise it. One more thing worth saying clearly, Iggy's framework is deliberately conservative because the audience I build this for is the retiring or retired Singaporean managing CPF, SRS, and dividend income. For someone at 55 with 20 years of savings on the line, a momentum growth stock that wipes out 30% in a bad quarter is not a learning experience. It is a retirement setback that cannot be undone. The 4.7% hurdle, the gearing ceiling, and the zone system are all calibrated for capital that needs to work reliably, not spectacularly. If you are 35 with a long runway and high risk tolerance, some of these thresholds will feel overly cautious, and they are meant to, because this framework is not for everyone. It is specifically for investors who cannot afford to start over. Let us look at the final classification ledger before we wrap up. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds. SRS, 100 Pension Mark.